So today we're going to go through the cash management trust. And this is something that a lot of you have been asking for the longest time. So if you've been following us at Risk Africa for a while, you know this is a conversation we started last year. And we will explain to you why we had to bring up this conversation and the main reason behind it, our big why, right? So today, I want by the time you are leaving this session, you fully understand how trust funds work in Kenya and what it is that you can do to make sure that, again, your people are secure, you have a peace of mind. So I'd like to introduce myself. My name is Mnyindo. I am the founder of Risk Africa. And at Risk Africa, we focus on the protection and preservation of wealth. My background is in financial mathematics, but I specialize in wealth management and specifically wealth protection and preservation because that is an area that I'm very passionate about. The one thing we realized about a lot of Kenyan families is we focus so much on the creation of wealth, but we tend to forget how to, you know, we forget how to create structure and protect this wealth. And this is the one reason why we have decided to focus on, because again, you can build as much wealth as you want to build, but if you do not maintain it, if you cannot keep it, if you cannot protect it, then it is as good as not even having it, right? Sorry. Okay. Awesome. Okay. Let's just continue. So this webinar is for you if you are a parent, an auntie, a grandparent who, want the best for yourself or even your kids and the generation after them. Again, this is not only for parents. It literally can be for anybody who has a child that they care about, which is very important because again, what you learn here, you can even go and teach your siblings, you can teach your grandchildren, and you can even, go and pass this message to your colleagues, because at the end of the day, we do understand how, children are very vulnerable, and we need to make sure that they are protected no matter what. Also, this webinar is for you if you want to set your kids up for success, but by putting their finances in order, your finances in order. Again, as I'd mentioned, you can make all the money you want to make, but if there is no structure around what it is that you're creating, then it's almost as good as building a home with no foundation. And also, it's for you if you want a simple and streamlined way of, setting up your family for success, and you want to take charge of your wealth and how it is distributed. In short, you are looking to be in control of your wealth protection and wealth preservation journey. Also, your wealth creation journey, because we have said you can create as much wealth as you want to create, but if it's not passed to the right people or it's not passed the right way, it does not even make any sense. This is a quote that I really like, especially now when it comes to focusing on how to take care of our kids and take care of the ones who are coming after us. But then, let me ask, can you guys hear me clearly? Maybe you can just say it you can say it on the box, on the comment section. I don't know if you can hear me clearly. Okay. Can you all hear me? Great. Let's just continue. Okay. I just wanted to make sure. So it says here, I will not burden you financially because I do not want what is yours. Not your money, not your possessions, but you. For children are not responsible to save up for their parents, but parents for their children. You know, when it comes to our culture, especially our African culture, we have seen a lot of black tax. And most of the time, it's because a lot of parents, a lot of families come from the mentality that the children are meant to take care of the parents. Yeah. But when I saw this scripture, it made so much sense to me because, again, we are the ones who brought these children to life. We're the ones who are meant to take care of them. So it will be good if we put our things in order so we do not have to burden them. Because at the end of the day, even where it is that you are, especially if you're someone who is right at this point, maybe taking care of your parents, taking care of your kids, you know how heavy it can be. So we truly believe that it is important for us to create the right structures so that we do not become a burden to our kids. Why did we start this conversation, especially on trust funds? Because for the longest time, we've been focusing, okay, on creating protection through, say, life cover, building your wealth, making sure that you've taken care of your kids. But we have seen so many stories and we've come across a lot of situations because of lack of structure, children end up suffering. So I don't know if you or any person that this could be the questions it is that you're asking in your mind, because we have quite a number of you who already have life covers or are thinking about having a life cover. So a lot of our clients came to us, maybe people are taking covers of 10 million, 20 million, 50 million. So one of their biggest question was, what tool can I use if I'm not comfortable with the guardian receiving the lump sum from my life cover or pension? Because remember, life is a journey. And right at this point, we are taking care of kids, right? And we want to know that in the case of anything, that these children are well taken care of. But the question is, if I was to get this life cover, or was to get this pension, how assured am I that it will go to the right people? Because sometimes this money could fall into because you remember, when your children are below the age of 18, they cannot have access to this money. But then what happens if this money falls into, say, whoever it is that you've chosen as guardian, and it does not get to your kids? And then another question is, I have cash in the bank. Yeah, because a lot of you have been saving money through your banks or through the money markets. But okay, you have money in this bank, you have money in the money markets. What if you're to pass away or get incapacitated? How will your dependents access this money with ease? Because again, you know how hard it can be when you know that you have money, but you have no access. It can be a nightmare. And you can imagine now at this point, there's children involved. They want to access this money because they need food, clothes, and shelter. But because of lack of structure, they cannot access this money. So that means they have to go through the long process of the courts. And I don't know if you've ever been through that process, you know how hectic it can be emotionally, equally financially, because you need to pay lawyers and the process can be so long. So what if, you want to make sure that, yes, I have this money in my bank account or I have this money in my money market. How can I make sure that in the case something was to happen to me today, my children, my family can still be able to access it with no stress? And thirdly, how can I save up for my kids' education or even for their startup fund and maybe in other ways other than the education policies, and make sure that the funds also do not go through the courts? If those have been your questions, today we'll be able to answer it. So these are questions I also want you to ask yourself. Are you interested in making any of these decisions? Number one, who receives my funds? Yeah, it's good to know. Are you interested or do you want the courts to decide? Because either way, someone has to make a decision, right? So if you were to get incapacitated today or God forbid to pass away today, who is the person who you want to make a decision? Because again, if nothing has been left in writing, it means the law of Kenya has to take over. Secondly, when your heirs receive your funds, who do you want to decide? Do you want the courts to decide or do you want to have a say? Thirdly, who can be the guardians for my kids? Again, do you want the courts to decide or do you want to have a say? You can tell us in the suggestion box or the comment section to let us know who do you want to decide the well-being of your kids, how your money can be accessed, who will be the person who is in charge of taking care of your kids, right? That will be important to know. Again, so the webinar goal for you from us, if you're coming from a place where you feel disorganized or anxious or stressed, or based on how your finances are all over the place, there is potential of chaos in the case of an incapacitation or or even a death, or at this point, if you feel disempowered and things are all over the place, we would like you to go from this part to you feeling organized, or being organized, for you to come to a peace of mind and a place of minimal disruption instead of chaos, and a place of feeling empowered. Because we know as parents, or we know as caretakers or guardians, the moment we have put our matters in order, it is going to be so much easier for us to, even if we're in business, to even take so much more risk in our business, to take so much more risk in our investments, because there is structure, and we know at the back of our minds our kids are taken care of no matter what, right? If we know that no matter what, everything is going to be in order, it will give you that confidence to be able even to take investments with peace of mind, or if you're in business, to do your businesses in a peace of mind, because you know that, okay, on the side here I have structure, so in case of anything, I know that my kids are taken care of no matter what. And our bigger goal is, building a legacy-minded family movement. We know where we are coming from. Again, a lot of us have come from situations where we need to make sure that we're the ones who are taking care of our families, or we have seen the generational cycle of bad decisions, especially when it comes to money. So in the overall picture, and even if we're talking about trust funds here, we just want you to have that mindset shift on how we are going to move forward, on how we are going to be able to create structure for our families, for ourselves, right? And secondly, to be able to break generational cycles of bad decisions. Because again, if we are not the ones who are going to stop it, it means it will have to pass down to our kids. But I hope that we're going to be the people who are going to make this stop, the things that it is that we've observed in our families and we do not enjoy or we do not appreciate. We're the ones who are going to be the pivots and move in a different direction. And thirdly, our big goal for you is to empower you, right? And also to secure futures and protect dreams of our kids. And right now, we are very big advocates of you taking your power back. Because again, as I said, if you do not make this decision, the government will make this decision for you. Relatives will make this decision for you. Or even strangers you did not even expect will make decisions for your money that you've worked so hard for the benefit of your kids. So it is time to take charge, create structure, and create a financial clone of you. So today we're going to show you how you can best go about it. As I said, this is going to be a proper backup plan in the case of the unforeseen, and especially for anybody who cares about children who are usually between the age of 0 to 18, or children who are below the age of 25. At this point is where the children are highly dependent on you, right? So what will this do for your kids? We've seen what it will do for you. Yeah, it will leave you empowered. It will give you a peace of mind. It will make sure that you're breaking the generational cycle of, bad decisions when it comes to finances. But what will it do for your kids? First of all, there'll be minimal to no interruption in their lives, because we understand that between the age of 0 to the early 20s, that is when our children are mostly dependent on us. So if we make the right decisions, especially during this season, it means that even everything it is that we have equipped them at this point, they'll be able to take it to life, and they'll be able to live a fulfilling life. Even if there's a level of disruption after the age of 25, at that point, they are grown enough to be able, to some extent, to take care of themselves. But when the children are young, from 0, 1, 15, at that point, if there's any disruption in your life, there's going to be a disruption in their life. So first of all, we said minimal to no interruption in their life. Secondly, give the children a head start in life. Again, how many of us wish that our parents had given us some level of head start in life? Because some of us are in business. It would have helped a lot if maybe there was some money which could even help you as capital. We don't have to always be hoping that there's people out there who are going to give us money. There could be people even in our own families, because they made a plan in good time. They can be able to take care of this situation, right? And then there's protecting dreams and visions of their kids. Because again, our kids have their own hopes, they have their own dreams. And again, if our lives are not structured, if our lives are not organized, it means that their dreams will be disrupted the moment our lives are disrupted. Again, especially when they're between the age of 0 to their early 20s, when they're fully dependent on us. And one thing we have to put into consideration is there's families who have special needs kids, and usually at this point, these children might be dependent on them even beyond the age of 25. Right? So it's on a case-to-case basis. We need to make sure that there is structure, there is protection for our kids, no matter what point they are in life. And lastly, financial stability. What could disrupt your children's lives, right? And it's good when you're thinking about protecting your kids and protection planning, because right now you are the parent. You know, even at this point, if someone was to come and even beat your child, you know how you will wake up and rise and go and try and sort that thing out, because you really are protective of your kids. The one thing I have observed is we are very protective of our kids, whether it's in a school setting, whether it's with other people. But the one thing I've seen that is still missing is now the protection when it comes to the financial angle, right? How are we really protecting our kids, as I said, between the age of 0 and 25? So creating structure and providing income replacement in the case you pass away, get a critical illness or disability when your child is dependent on you is extremely important. So you see, as I said, when it comes to between the age of 0 to 25, even if a child was to get any money at that point, we can't even really consider it an inheritance, because that money will still be used to take care of their food, clothes, shelter, right? And even to be able to take care of their education. Yeah, I even put education almost as a basic need, because we know education is a doorway to so many opportunities. If they're to receive this money after the age of 25, it means most probably at that time, if everything has gone well, they finish school, their things are in order in some extent, they're able to even go and have a voice of their own, and they're able to now, to some extent, take care of themselves. So at that point, it can even come in as an inheritance. Yeah. So what are the consequences of a death or incapacitation of a parent without a plan? Right? Again, as I said, these are things that are happening every single day in our country and even in the continent. It's just that we do not talk about it. But again, sometimes you just need to check closely, and you might know someone who's going through this. It might not be directly in your own family, but it might be someone it is that you know. So kids are split from one house to another because they're considered a burden. Again, there is children who they have to have there's a downgrade of lifestyle, right? From schools to their home to, again, maybe the activities that they were used to. You can imagine your child was used to going to play this type of sports, maybe whether it was tennis or you are a soccer mom, your children are very excited. But then in the case something was to happen to you, it doesn't even have to be a death. It could even be an incapacitation. Sometimes people get sick, like a cancer or a stroke, and for some time they're not able to do what they could do before. And again, that means that there's going to be a downgrade of their lifestyle, because if the money is not coming in as it used to, that means that, again, the children and whatever it is we could afford can no longer be afforded. Then there's the actual trauma from the death or incapacitation of the parent, and there's the risk of being taken advantage of by relatives or even strangers. And there is the long court processes. So what is the goal of setting up a trust fund? First of all, is to ensure the assets are distributed according to your wishes. When it comes to wealth management in general, wealth management is it has three sections, yeah, three pillars. There's the wealth creation, which a lot of you focus on. Wealth creation, this is where you make money. That means you're going to work, you're making this money, you're taking this money into an investment, you've put this money in a money market, you have put this money in the bond, you've put money in the stock market, in real estate. And again, we are putting this money so that we can be able to grow and multiply our wealth, right? That is wealth creation. The second part is wealth protection. How can we ensure that this wealth that we're creating is secure, right? And there is wealth distribution. How do we pass this wealth from one generation to another? Because if there's one thing we need to remember is we are not here forever, and this wealth will have to be distributed at some point. So again, as I'd mentioned from the very beginning, it's either you decide or the courts decide. Another second goal is to keep kids out of survival mode. Because if there is no plan, if the children have no money, that means they will be fighting for food, clothes, and shelter. Even if you've brought up your kids with the best values and there's no food, clothes, and shelter, that is when even a child can go and live with somebody, right? They can go and steal just because they need to get their basic needs met, right? And number three is to give your children a competitive advantage in life, but by giving them a head start. Sometimes, as I said, we could have the best ideas, but we don't have the funding, right? You want to go to school. And at this point, especially from what it is that you can see in our country, when it comes to the bursaries and how they're being disbursed, there is an issue in even how the government has structured it. And again, so it means you can no longer depend on someone, or you can't even depend on the government. And another way of giving your kids a competitive advantage is in the house down payment, right? Sometimes you want to make sure that your children always have a place to stay. So this could be a gift, right? Other people, some of our clients even put this money aside for different milestones in their children's life. They're like, okay, the moment they're ready to get married, there's going to be money in the pot. The moment it is that maybe they want to have their masters, or they want to travel, they have access. The biggest goal, again, is to make sure that our children have access to these funds when they need it. And lastly, to ensure that the kids' lives are not interrupted if a parent dies, gets an illness, or a disability. So let's talk about trust funds in Kenya. So trust fund is it's what we used to call it a trust fund account, but again, this is what we call a cash management trust, right? A cash management trust or a trust fund is a legal and financial arrangement designed to protect, to manage money for the benefit of your child or a family member for a defined purpose. Again, please also remember it's not only children you can create a trust fund for. We have people who create trust funds also for their parents, where it is that they put money, but because their parents are elderly, you can be able to manage, or the trustees are going to be able to manage this money on behalf of your parent, because they are also a dependent, because dependents do not have to be children only. Dependents could be siblings. Maybe between you and your sibling, there's a big age gap, or your parents are maybe in their 70s, 80s, and you want to make sure that they're taken care of no matter what, and the structure around the money. Yeah, again, so it's not only for children, but at this point, because a lot of the conversations were around protection of children, so you'll see me talking about kids a lot, but it can literally be for anybody. Yeah. And number two, it allows you to set specific rules and conditions on how and when the funds will be used, right? Ensuring that the funds are preserved and are utilized according to your wishes. The one thing I want you to think about is this trust fund as a secured pot of cash for the benefit of your loved ones. I want you to put that picture in your mind. There's this pot of cash, or there's this safe of cash that is secured, right? It is secured legally, financially, to make sure that the access will be given to the people who are meant to have access. So in this case, maybe now your children, right? And again, why do we set up a cash management trust? Because first of all, security. You need to make sure that this money is well taken care of, is protected, no matter what. again, because as I mentioned, sometimes a lot of us maybe pick family members or we pick our friends, but you can never really tell when you are not there how this money is going to be handled. But we're going to go forward and you'll see how exactly the cash management trust is structured, so you understand that nobody can have access just the way it is that they want. There's going to be that extra barrier to just make sure that nobody can just pick from this pot. Remember, it's a pot. Nobody can just pick money from this pot where they're not supposed to. And then there's controlled access because there's someone who's managing this trust fund. It means that there will be the person who it is that requires this fund. There's going to be some level of control. Someone can just not wake up and just choose to go and receive money from the trust fund. And then there's efficient cash flow management and supplemental income. We're going to discuss that more. So how is a trust fund structured legally? Because most of the time when we think about a trust, we think of, maybe a private trust or a family trust. Yeah, depending on how it is that you call it. Because when it comes to a family trust, remember it is a legal entity and on its own, just the way a company is a legal entity. And when it comes to a family trust, how it is that it's structured, there is the trustees, the people who manage the trust. There's still the settlers or the grantors, the people who are creating the trust, and there's the beneficiaries, the people who benefit from the trust, right? You have to create this trust from scratch. That's why you can see, depending on the lawyer it is that you go to, you'll find that the cost of setting up this trust could be 200,000, 250,000, 350,000. But you ask yourself, okay, when it comes to trust fund, especially for the ones who've been following us for some time, you have seen to create a cash management trust or a trust fund account, you only need maybe a minimum of 5,000. And I want to explain why that is the case. And also we have Winnie here who will also explain further how exactly the trust fund is structured legally so you can understand how it works on a fundamental level, right? So remember, with a private trust, you create the trust from scratch. But when it comes to cash management trust, the trust has already been created. It is already in existence. You are going to just take a bit of space in that overall trust, right? So look at it like there's that one major pot, and then you are just going to rent a space, right, within that pot. So when it comes to the legal structures, they've already been created. When it comes to the trustee, you'll see there's already an institutional trustee who's going to be managing the trust. And then let's just say the fundamentals have already been taken care of. So you just open your specific account, and within that specific account, you are still able to get the benefits of the overall trust at a more cost-efficient way, right? So this is why to set up a trust fund is going to be so much affordable compared to, creating a family trust on its own. And also later we're going to see the advantages and maybe the limitations of a trust fund as well. So at this point, when you're starting out, this is a very good place to start out. By you opening up this account for the child to make sure that you're setting this money aside. In the case of anything, there is a way that this money is going to be distributed or disbursed, and I'm going to show you how, right? This part we will let Winnie explain, and we will go through it towards the end to fully understand and grasp how the cash management trust is structured, yeah? And also she will take us through how the trust fund is regulated and who regulates the trust fund, because this has also been a very big question on how exactly are the trust funds regulated and how assured am I that the money is going to be be taken care of at the right place and be distributed to the right person. Sorry. Okay. Let's talk about the cash management trust process. So when it comes to the cash management trust process, we have a way it is now created. So let's say at this point you are like, okay, I want to create this trust fund account for my child. So what happens is you, as the grantor or the creator of the trust, are going to be the one who creates the trust fund. Because remember, yes, there's the major underlying trust, but you will open that account, that small space that you're going to rent, to be able to save this money up for your child. And then these funds are managed by a trustee. So the trustee here is an institutional trustee. That means, because remember, with a cash management trust, as we'd said, the setup and the structure has already been created. So they've already decided who the trustee is. And in this situation, it's going to be an institutional trustee. Funds accessibility, you're the one who's going to decide how the funds are going to be accessible to the children or whoever it is that you have put in charge of this trust fund. And then income generation. Again, because we are putting money in this trust fund, it's not only stored, it actually grows, which you're going to see when it comes to how it is that you could grow a proper investment portfolio for your children. So what are the key components of a trust fund? The key components of a trust fund, maybe you have heard me talking about these words, and I want it to be very clear who does what, right? So we have, first of all, the grantor or the settler. You are the one who creates the trust fund. So you could create it yourself, you could create it with your spouse, you could create it maybe with a sibling. It can be a joint trust fund account, or you could now do it yourself. It's all dependent on what is the overall goal, right? So you are the one who creates the account. And we have a trustee. Trustee manages the trust and ensures the proper fund usage. So they're overseers of the trust fund, right? And then we have the guardian. In as much as the trustee is the person who's overseeing the funds and making sure that the funds are dispersed the way they're supposed to, there still has to be someone who is taking care of your child physically. So this guardian is the person who's responsible for your child's upbringing and well-being, right? So the trustee manages the cash and the money, and then there is the guardian, the person who is taking care of your child's well-being. So that means that if you are to pass away or to get incapacitated, this is the person you trust with your everything to take care of your child. It could be your spouse, or it could be a sibling, it could be your mother. It's up to you to choose who you want to be as guardian. And then we have a beneficiary, the person who benefits from the trust. As I said, yes, it could be a child, but it could also be a parent. Okay. So let's talk about the key features of a trust fund. Again, it's good to know how these trust funds work. So we've spoken about the components of the trust fund, which means who are the people or the key roles when it comes to this trust fund. Now we want to look at the key features of a trust fund. So first of all, a trust fund is very liquid. That means that there is access to this cash when need be. So for example, you have set up this trust fund for your children's education, or you set it up for their business. You still have access to this trust fund yourself as a parent. But in the case something was to happen to you, your children still have access to this money, depending on what it is that you have written down, according to how it is that you structured it. Secondly, it is low risk, right? Because usually, fundamentally, the underlying asset is usually a money market fund. Again, a lot of you have asked us what is the difference between a money market fund and a trust fund. It's more or less the same thing. The difference is literally the structure it's on. When it comes to a trust fund, it is seated on a trust. That means that it never has to go through, succession or the probate courts in case of a death or incapacitation. But we are going to have a conversation to see the way sometimes even the money you've put in your money market, the money that you've put in bonds in the stock market, if it's not been backed up with a structure, it will still have to go through this process. And yes, your children will know that maybe my parents have this, but they might not be able to have access to it until the whole court process is over. And then there is income generation. So as I'd mentioned, the money it is that you put in here ends up growing because, again, just the way a money market fund works, you put in money, the money grows. And there is professional management because the institutional trustee is the one who manages this trust fund on behalf of your kids. So what are the benefits of a trust fund? Yeah, why would you even decide to set up a trust fund? Why is it important? First of all, it provides an orderly means of administering personal and financial affairs should you become dead or incapacitated. We have seen, and maybe you've heard, how when a parent has passed away, there is so much chaos, right? When you set up a trust fund, because of how the structure is, it means there's already an orderly way of making sure that your affairs are taken care of. You've put all these things down in writing, and we're going to show you how to go about it. It's not complicated at all. It's very, very smooth. But at least you are assured that this money, I want it to go to my kid at these ages, whether it's 18, 21 for school, it will actually go to the children, right? It's easy to set up. The settler, which is you, or the grantor, which is you, the one who's creating this trust fund, only signs a summarized trust document grant letter. Because remember, the bulk of the work has already been done, the creating of the trust. You are only taking a bit of a space of that trust in what we call the trust fund account so that you can be able to manage these funds on behalf of your child. Again, it is very affordable to set up. As I said, to get started, you only need 5,000, and it's very flexible. You can put 5,000 now, even if you don't put next month, it's not that it's going to lapse or you're going to be penalized. Again, it's always good to have the end in mind and to be disciplined. If you've told yourself you're going to be putting 5,000 a month, just do it because there's a specific goal you want to reach, right? And then we have the trustees who offer also investment advice to help you reach whatever objective you want to reach. Okay. And funds are protected from creditors' claims. So again, if you had creditors who come for your things, it means that the money that is going to be in the trust fund is not going to be touched. What is the reason? Remember, you have transferred ownership from yourself to the trust fund. Before, you are the owner of this cash, you're the owner of this, maybe, the funds that you're putting aside, they were in your name. But the moment you transfer or you start contributing into the trust fund, now the ownership has been transferred to the trust fund for the benefit of your child. So if someone comes for you, right? Because you and the trust fund are two separate entities. You and the trust are two separate entities. It means a creditor cannot touch this cash. So if you want to put aside some money for the benefit of your child and you want to know that no matter what, nobody will touch this money, a trust fund is a very good place to be. And then the funds held under the trust fund account do not go through probate. Again, as I said, when someone passes away, you have to go through the courts. Just as I'd mentioned at the very beginning, it's either you choose how the money is going to be distributed or the courts choose, because either way, someone has to do the choosing. You have to be the one who is empowered enough to make this decision. Again, it also gives you peace of mind knowing that when the unexpected happens, your legacy is preserved for your loved ones. You do not want a legacy of chaos and legacy of people fighting just because you could not create the necessary structures. So this is just a summary of the benefits of the cash management trust for especially parents or guardians or anybody who's taking care of the kid. So there's the short-term security. In the case now, there's need for school fees or medical costs. There's controlled access because there's actual rules and regulations on how this money can be accessed, and the access is going to be according to the child's best interest. And then there's also efficient cash flow management. So it will minimize overspending and prevent mismanagement. Again, as I'd said, one of the reasons why we had to introduce this is because sometimes you leave a lot of money with your relatives, family members, but maybe because they do not have the knowledge of how to manage money or because of malicious reasons, this money is mismanaged and will never reach the kids. But you see, if the money is going to be in that secure pot, that means that it will be there's going to be minimized overspending, there's going to be structure, right? And then the supplemental income. There is low risk investment because we say the underlying investment is actually the money markets, unless now you want to now build a proper investment portfolio, which we're going to show you how to go about it. And then there is return generation because of the compounding effect of money. Again, those are the key benefits of a trust fund: security, protection, control, and growth. Right? When I say that a trust fund or creating a trust is a financial clone of you, is because these are things you already currently do for your kids. right? You make sure that they're secure. You make sure that they're protected. You make sure that, you have control over what happens in your kids' lives, right? And you make sure that there is growth. So even for you, and when it comes to now from a money perspective, this trust fund can help you when it comes to that. And what are the uses of a simple trust fund? So you can use it as startup capital. Again, as I said, children could have ideas, but they don't even know where it is to start. So maybe when they're grown up, maybe they're 25 and they already have an idea and they want to start a business. There is money, there's access to money for them to be able to start that business, right? And just to test the waters without having fear of failure or having fear of where am I going to get this money. And you can also create an education fund. Yeah, because again, we also want the best for our kids. We need to make sure that we're putting aside this money so when it's time for them to go to school, there is already available money. We're not going to be dependent on the government. I hope for anybody who is joining this webinar are visionary parents, because the moment we decide that we're going to be dependent on the government or other people for our children's education, we might not get the quality it is that we want. And we are seeing here the way there's children who cannot even go to campus at this point because there's so much confusion even in the government when it comes to now the disbursement of funds, right? And you can use this money for, as again said, house down payment. Other things you can use the money for is medical care, right? You can also use this money for upkeep. Because remember, at the end of the day, you just want to make sure that this fund can be able to take care of the child financially the way you would have. Okay, so let's look at trust fund as a secure pot of cash. I wanted you to use this analogy so that it can be easy for you to understand how trust funds work. And anytime someone maybe asks you, you can be able to explain to them in a simple way. So look at the trust fund as a central port for your child's future, right? You've put this money, whether it's for education, whether it's for their upkeep, whether it's for eventually for them to have this money for to start a business, or it could even be all of the above. You have set this money aside so that your children can be well taken care of, so that your children's lives are not interrupted. Yeah. So there's the pot that has been created by you, the grantor, as the parent or as a sibling or as a grandparent or as an auntie. Literally anybody can create this on behalf of somebody, yeah, who will be depending on it. So it could be children, as I said, your parents, as another sibling. So you as the grantor, you set up the trust fund and you come up with the rules, right? And then there is a trustee. The trustee, the person who is going to be managing this trust fund. And as we had mentioned, in this case, the trustee is an institutional trustee. This one, you do not have the flexibility to choose who's going to be the trustee because the rules and regulations of when they came to the creation of the trust were already set up and they've already decided who is going to be managing this trust. The only time you can choose your own trustee is if you have your own private trust, right? We'll go into that later. And then you have to choose a guardian. Supports your child if the parent is absent. And then we have the trustee versus guardian, because again, sometimes people confuse what is the difference between a trustee and a guardian. So the trustee is in charge of the financial oversight. So the financial oversight focuses on the trustee and the emotional support role on the guardian. So this is balancing the financial and emotional roles of a trust, because again, you cannot only have the person who's managing the funds without the person who's managing your child. We're going to go shortly on how it is that you can choose a guardian, but it's good to have a good balance of both. There's someone who you truly trust to manage the funds, and there's structure around how it is that they manage the funds, and there's the person who can give emotional support to your child. It will be the person who's actually living with your child, because you cannot take your child to live with the institutional trustee, right? It's a company. So how do you pick a good guardian? This is also part of creating of the structure, because you said, okay, you've created the trust fund. You are the grantor, the parent. you know who the trustee is. So how do you pick a good guardian? A lot of people get stuck here. I know it's very difficult to think of someone who can take care of your child the way you would have, but it's so necessary to make sure that in case of anything, there's someone who can actually live with your child. Because again, if you also don't pick a guardian, the courts will pick this guardian for you, and they might pick someone you don't necessarily, or you'll never have necessarily picked by yourself. So how do you choose a guardian? Number one, it's good to look at the relationship. Select someone who loves and understands your children. When you're picking a guardian, you can already see how when they come and meet your children, how is it that they interact with your children? Are your children even comfortable to be around this person, right? Because at the end of the day, it's good to pick someone who already has a good relationship with your kids. It will make life easier. And then values. You ensure their morals, their beliefs, and parenting style align with yours. Sometimes you could have a friend, a very good friend, but how it is that maybe they're raising their kids or their parenting style is not necessarily your cup of tea, or it's not even coming from a judgmental point of view. It's just that how it is that you choose to raise your children, your philosophies of raising your children are just different. So it will be good to pick someone whose philosophies are close to yours or very similar to yours, right? Number three, there is stability. It's important to assess their financial, emotional, and lifestyle stability. Because again, will this person be able to take care of your child? Is this person of sane mind? Do they have also their own finances that they can take care of themselves? So even if you were to leave an extra amount here to take care of your kid, it is still possible. Yeah. So it is good to know if these people are financial, like there's some level of financial stability, a level of emotional stability to be able to raise your kids, and also their lifestyle to some extent similar, right? Or not too far off from yours. So that even in the case of a transition, the children do not have to go through a very big shift. Then there is willingness. Because again, you could pick a guardian, but are they willing to take care of the child, right? It's important to see if you can be able to, if they're willing to take care of your child, are they ready to? And again, if someone is not ready to, you should not feel bad about it. Maybe it's where it is that they are in life, but it will be good to pick someone who is okay with it. So that's why it's important to have the conversation. Health and age, pick someone who's healthy and capable of long-term care, because remember, this is someone who's going to be taking care of a young child. So again, even if you're to pick your parent, it will be good now to pick a backup option. You can see here, just in case, because most probably your parents are older than you, but in case something was to happen to your mom or your dad, who you chose as a primary guardian, who can be the person who's next in line? Could be a sister, right? Location, yeah. Consider their living environment and its impact on your children. So if your children's lives are already centered, let's say Nairobi, right? And the person who it is that you're choosing is their lives are centered, say, in somewhere up country. It can be like, okay, maybe like Nyeri, or, can be Taita, wherever. How will that shift be for your child, right? So it will be important to figure out what is the location, or which is the living environment, and what will be the impact of my kids. So if they're to move to where this person is living right now with their family or themselves, will it create a big shift to your kids, right? Again, if all of these things is a give and take, maybe the person has all the qualities but lives in Mombasa, you can be like, okay, it's okay, because the children can still be able to get a good school on the other side. And then also, it's important to legally prepare this guardian, legally appoint them, and provide financial support through life insurance or a trust fund. Again, remember, your guardian could be someone who already has a family of their own. All right. Like, let's say at this point right now, I have two children. So if someone is going to be, and I plan to have only those two kids, If someone is to add me two more children and I did not financially prepare for that, it means it will strain me and my kids. It doesn't mean that I don't want to take care of your kids, but if you're picking a guardian, it will be important to think it through and be like, okay, in case something was to happen to me, this person will be living with my children. How can I make sure that there is money for this person to still be able to continue taking care of my kids? So that they don't have to really shift their lifestyle that much to be able to accommodate. Or if they were living in a 3-bedroom house, they have enough money to move to a 4-bedroom house to accommodate your kids. I know these are things most people don't think about, but it's so important to think about, because the moment your child goes to live with this guardian, also your guardian's lives will change. So it is important to put that into consideration. Is this guardian financially capable? If they're not financially capable, and even if they're financially capable, have you spoken to them about it, with them being able to share their money with your kids? Because this is the point where if someone was resenting it, you see that they don't treat your children as well as they should, because almost like they did not expect this to happen, but it's happening, and they're not doing it from a very good place. This is why it's important to create this structure. So keeping the pot full. Again, remember, as I'd given the pot analogy, you've created this trust fund and you started putting money into this pot, right? And it's very important to ensure that this pot is never empty, because remember, some of these goals could be immediate for your kids. Some of these goals could be coming in later in life. So you need to make sure that the pot is always full no matter what. So to make sure that the pot is never empty, you need two key strategies. Number one is life insurance, the backup filler. So the life insurance acts as a backup tap connected to the pot. So in case something was to happen to you, the life insurance payout flows directly into the pot, ensuring your child's future is not interrupted. I want you to picture this. There's this pot, you've opened up this trust account, the pot, and you've put in 5,000, and you keep on putting 5,000 every single month. This parent is putting 5,000 every single month. Let's say in year 2, right? This parent passes away. So the amount of money that the parent that is in the pot will be the 5,000 accumulated for the last 2 years plus the interest gained. So most probably it might be about 140,000. The question is, in year 2, with that 140,000, will it still be able to take the child to school? And for how long? Will it still be able to, take care of the upkeep of the child? And for how long? You know, it's very, very important to ask yourself, because right now my children are vulnerable between the age of 0 to say the early 20s. How can we make sure that even if something happens to me in year 1, even if something happens to me in year 5, my children's lives are minimally or not interrupted at all, at least financially? Because the worst thing for a child to go through is the interruption emotionally, mentally, and then now, in addition, financially. This is when now children go on survival mode. And at this point, because there's no money, and maybe you did not even decide who's going to take care of the children, this is where now the children end up being bounced from one house to another. So if you have a number of siblings, maybe they'll be like, okay, between January and March, I'll stay with this child. Between April and June, I will stay with this child. Do you understand how unstable that is for the child? And they'll almost feel like they're not cared for. So it is equally as important to make sure that there's some level of stability financially, and also stability with the people, the one person you've chosen to take care of your child. So an example, a life insurance policy, say, of 10 million will ensure the pot is replenished at any point, even if you're not there to add it yourself. Because remember, the reason why there's a life cover is an income replacement. You're the one who's been contributing this money every single month. The moment you're not there, there's no more contribution, right? So it's important to always have a backup plan. Again, I wanted to show an example through these cups. So you can see here there's an empty cup, and then there's a cup that is half full, and then there's a cup that is full. So the analogy was, okay, you started here with an empty pot or an empty cup, and then what happens if a parent passes away when this cup is quarter full or half full? It means that if you wanted this child to go to university, they might not be able to go to the university of their choice, right? So this is why I say when the contribution stops due to death, serious illness, or disability, this is where now the life cover has to come in, right? So you can see just like this pot, when even if the pot was empty or half full, what the life insurance is coming to do is to fill up that cup, is to fill up that pot so that there's minimal interruption, right? So just think about it always in that way. You've opened up this trust fund, you're contributing every month. You do not know what will happen even in 6 months, in 1 year. Life is a long journey, anything could happen, but interruption of our lives means interruption of our kids' lives. So we need to make sure that the pot is always full. So let's look at life insurance and the financial security sequence. So life insurance policy is put in place. So a policy is established to secure funds just in case. And then let's say there's an unforeseen events that happen, whether this policy holder has passed away or has gotten a serious illness, they faced an unexpected event. So what happens is the payout is done into the trust fund pot. Because remember, if you have, let's say right now you already have an education policy or a life cover, most probably you've already decided who is guardian when you're filling in that form. So in the case of that situation, if you are to pass away, the money will go into the guardian's account directly. But if you have a trust fund account, instead of the money going into the account of the guardian directly, it will go into the trust fund and the amount will be dispersed slowly but surely, depending on what you had decided that money will be used for. And then at the end of the day, the child's future is secured. So let's look at just illustration of life cover so you can have an idea of exactly how much they can be. So you can see for this person who is 30 years, the life benefit is 10 million and 5 million, critical illness and disability for 20 years. You can see the premium is only 6,600 per month, and they're only paying it for 20 years, but covered for life because it's a whole life cover. For the person who's 40, you can see it's a bit higher by almost 3,000, right? Because life insurance is dependent on age. Again, it's very important to be able to get it as young as you can. And remember, life insurance is the replenisher of the trust fund. In the case you are not able to make it through the whole time, the whole 20 years contributing for your child, in the case it was year 10, this trust fund will come in to fill in that pot, plus some change. So you can see here, the person who is 40, it's 9,000 if they're non-smoker. Again, there's different costs between smoking, when someone is a smoker and a non-smoker. When someone is a smoker, for the exact same 40-year-old, instead of 9,000, they'll be paying about 12,000, almost 3,000 extra, just because of that. And again, it's always important when you are filling in the form to be as truthful as possible, because the worst thing is if someone was to pass away, say from lung cancer because they were smoking and they did not mention it when they're filling in the life insurance forms, they're really putting their children or their families in trouble because the insurer might not pay, right? Because you didn't say the truth from the beginning. And then there's this person who's 50, for the exact same 10 million shilling cover, they have to pay 18,000, right? Again, so we've spoken about the life insurance as now the backup plan, right? And then now we have the investments, the growth engine inside the pot. So remember, when we're getting started, when we're contributing the money, say the 5,000 every single month, the underlying investment we said is now the money market fund, because the fund manager usually has picked something that is very conservative. And remember, their biggest goal is security, right? But you can also have access to other investments, even as long as now there is enough money to be able to buy those investments over a period of time, which again, in this point, Winnie will explain to us towards the end of this session, just to understand even how can you do it. So at this point, I'm saying investments like the money market, bonds or stock market inside the pot will act like seeds that multiply over time, making the pot bigger and fuller. And remember, this is a pot that is growing with your child. So you can start right now, say like at this point, I have a 4-year-old and a 5-year-old. Maybe they might not know much about investing or much about money, because at this point, all I've done is just give them a piggy bank. But say they are around the age of 10. Now you can even introduce them to their own trust fund account. Yeah, you can introduce them to their own trust fund account, and it can be a point of learning, right? remember, you'll be buying these bonds and shares from the stock market through the trust fund. So that means all these investments will still be secure within the trust fund, right? That is the one of the big advantages compared to now, buying them on the side. We'll explain to you how it's for the people who already have already existing bonds or already existing maybe real estate investments, how they can handle that. But for now, remember the cash management trust is for investments which are cash or cash equivalent. So yes, the underlying investment right now can be a money market, but say your funds have reached maybe 200,000, 300,000, you can buy a bond or even several bonds if you want the money to grow faster, right? And it's also dependent on your risk appetite. At this point, even the institutional trustee can guide you on how to best go about it. Because you see, if you want to be able to access or to be able to no do create your own investment portfolio, all you need to do is give instructions to the trustee in writing to tell them that you want to buy these bonds. Yeah. And then now they will be doing it for you. Because remember, they are the ones who are the managers of this trust fund. So it means that it's even taken away that weight for you to be buying these things by yourself. Yeah. And we'll give you more examples later. So example, let's say you've invested 1 million in stocks or bonds and over 7 years, it grows to 3 million or even more. It ensures that there's more money for your child's future needs. Yeah. So this is the trust fund growth cycle. There's the initial investment. So let's say right now you're opening the account. We're going to show you how to open the account, and then you continue putting the money in, the money compounds. And then you can, as I said, choose to buy whichever investments. Again, you'll be consulting with the trustee, and then the future needs fulfillment are going to be taken care of your child. Okay. So just look at a simple trust fund. This fund is held in a secure investment kitty which preserves capital. Like when you're looking at it from a basics perspective, you've not even put money, like you've not even given instructions for it to, be invested in a bond or shares. This is just the bare minimum, right? So the money is secured because remember, there's all these, there's the trustee, there is, the actual trust structure, there's you as the grantor or the settler, the person who's creating this trust fund. So think about it as it being held in a secure investment kitty that preserves capital. The return is usually just the money market fund returns, right? So you can always check the newspaper to see how it is performing, around 10 to 13% per annum, still also compounded, just the way a money market fund works. The only difference, because a lot of people are like, okay, I'm already doing it through the money markets, why would I instead do it through the trust fund? Is because of the added layer of legal protection. Just as you've seen, with a money market fund, you cannot choose who's going to be guardian. You cannot choose how the money is going to be distributed. You cannot decide, oh, I want the funds to be distributed at this age, maybe 21. I want the funds to be used maybe when my children are in university. So this trust fund creates more structure compared to a money market. And both of them can coexist at the same time for different reasons. I have my money market fund for emergency purposes because I want to know, like, okay, in case there's an unforeseen circumstance in my life as Mnindo, I have access to these funds. And I've created now the trust fund for my kids for their future, right? So I have separated the account. So it's very clear my kids' account is this, and it's very clear that my account is the money market fund account. So the trust fund account is for my kids. I have connected all my insurance policies, my pensions, everything. In case something was to happen to me today, I've structured it in a way all the money will go into this central pot for consolidation, right? And so that now in the case now when it comes to the distribution is going to be from one place. Because you can imagine in case a parent has passed away and maybe there's money through the company benefits, let's say company, the group life cover, group pension, someone has to go around to all these places. The person who will receive this money, as I said, is whoever you've chosen as guardian. But wouldn't it be better if you consolidate everything into one pot? So in case of the unforeseen, all the money is going to go into one pot, whether it's your life cover proceeds, your pension proceeds, and then how it will be distributed to your child will be according to your wishes, right? Anyway. And here I wanted to remind you the contribution is very flexible. So you can start with an amount, let's say 5,000. You can even increase it to 10,000. If you have a lump sum, you can add the lump sum. And the minimum amount to start contributing is 5,000 shillings. And even if you put 5,000 shillings today just to create the trust fund pot, you can do that and then connect it to all your already existing, say, life insurance policies. And then maybe when your income has increased, you can continue. What right now is most important is to create that structure and put rules and regulations to that structure. So how exactly does the application process look like? So you're going to fill in an application form. I will guide you. I'll show you how to go about it and who it is that we've partnered with, and we'll also tell you who are the people who also offer trust funds in Kenya. And then you need to send the requirements, which is now your ID and KRA PIN, right, for identification. And then you also need to send your guardian's ID and KRA PIN because, again, remember, you're putting a guardian in case you're not there. They'll be the ones who are coming to now give, I mean, like, let's say, for example, to receive money for upkeep. How sure are we that we're sending money to the right person? Because, we need to make sure that, again, this is the actual guardian that you want to take care of your kids so that the money is not just given to anyone because the trustees are very, very strict. And then there's the beneficiary's birth certificate or ID. So if the beneficiary is your child in this point, is below the age of 18, you can give the birth certificate. But if they're over the age of 18, you can give out the ID. And then what happens is all this information is sent to the trust company, and then they're going to give you something called a grant letter, which is now going to be a summary of all the rules and regulation and what it is that you want the trust fund to be for, right? It's almost like a contract. And then you will sign it. You'll just go through it to make sure that everything is okay. You sign it. Then the trust fund account is open. And then at that point, you can update your life cover and pension beneficiary to your trust fund. So usually the time period to open a trust fund can take about 7 to 10 working days. So you can now start the process, and then within 7 to 10 working days, you already have your trust fund account up and running. You have your grant letter, which is important for you to put in order, put it in a good place, and then you can continue contributing, right? And then at that point, you've already started your relationship with the trust fund account and the relationship with the trustee, right? So this is how, as I said, it is. You give instructions. You've already given instructions because you filled in the form. You say that this money is going to be used for upkeep. This money is going to be distributed at this age. As I said, we're going to show you how. And then, yeah, the trust fund is created, and then you just start funding the trust. So what happens upon the demise of a parent? Because we've been talking about, okay, we are contributing this money towards the trust fund, right? Whether you've already set up your your life insurances, pension proceeds, you are also constantly contributing. So what happens if a parent passes away or gets incapacitated? So upon the demise of a parent, the trust fund becomes irrevocable, meaning all wishes one had narrated cannot be changed. You can only change your wishes when you are alive, right? Unless now you've given the power to somebody else, like a guardian, but most people just choose to make the wishes themselves. And then in the case they pass away, the last and final wishes are what are going to be carried on for life, yeah? From that point, the institutional trustee manages and distributes the funds as per your instructions, right? And then what is the withdrawal process for beneficiaries? There is the person who's designated as a guardian will write to the trustee. Yeah, so that's why it's important for the guardian to even know that this exists, because if they don't know how even it exists, how will they even come and ask for money, say for upkeep for your child, maybe to take care of their food, clothes, and shelter. Yeah, attaching the documents in support of payment request. So if you say that you wanted this fund for education, so what the guardian needs to do is to share the invoice and the payment can be done directly to the school. So you can see there's no exchange of money in someone's hands. They're not going to touch and then say they're going to take your child maybe to a cheaper school, right? So the invoice will be shared and the payment done direct to school. So if the fund was for medical needs, maybe your child to get medical insurance, the invoice or the quote is shared to the trustee and the funds are paid directly to the insurance company. You see, now with bank accounts can't do that. Money markets by themselves cannot do that. You see, now that's the extra layer of protection that we're talking about. Like literally, when we say a financial clone of you is the things that you could do, this fund is still be able to do, right? And then the payment request will be processed to the relevant parties depending on the type, on the request type, right? So I want us to look at even how it looks like from a numbers perspective. I want us to look at maybe even possible projection, right? So you can see this person is contributing 5,000 per month, and the interest rate at this point is average of 12% for the next 20 years. So you can see here that um, at the end of the day, the amount of money that will be accumulated at the end of 20 years, if that will just contribute 5,000 for those 20 years, is 4.9 million. And you can see here, Mary, because the parents are contributing a bit more, the funds ends up being even 6 times more. Yeah, like it will become about 24.7 million when this child is 20 years. So this money, as I said, can be used for different things. And again, that's why I mentioned that it's good to have that projection, but in case of the unforeseen, that's when I said the life cover comes in, right? And here is another good example. Like, let's say this person who has this child who is 0 years old and they want to grow their trust fund. So at this point, this person is is contributing 5,000 per month towards the trust fund and is contributing the 6,600, as I'd shown you before, because they're 30 years to get these benefits. So they'll be contributing a total of 11,698, and the child is secure. So that means in the case something happens to the parent, to Mary when the child is, say, like even 5, this 10 million is going to go into the trust fund pot and will be able to take care of Tony in the case of the unforeseen, right? Because remember, this trust fund requires time to grow because it's an investment. Yeah. If you're to be putting 5,000 and you pass away in a year, the only amount that is in that pot is only going to be 60,000 plus interest. But again, there's still a whole 20 years plus of which your child would have been dependent on you. That's why now we need this 6,000 to come in just in case, because we don't know at what point life can happen, right? And again, even if this child was to receive this money later, that extra 10 million later, there's nothing wrong with a bit of cash inheritance towards the children, right? And you can see here, this Mary will leave Tony and his descendants an assured 10 million plus through the life cover because again, that is the direction everybody is going through in life. Everybody's going to pass away at some point. So between the age of 0 to 20s, Tony will still be protected. That means that his food, clothes, and shelter will be taken care of, and education. After 25, maybe he has a job. Even if the money is to come at that point, it can be used for other things, right? That amount of money plus the amount that the parent has used to save up over that period of time until the age of 20, you can hand it over to Tony as a gift, right? And when I'd like Yes, so you can see now when it comes to structuring a trust fund, the most important thing is intentionality. It's very important to have that end in mind and to know, why do I need to do what it is that I'm doing? You need to create this secure pot, especially if you have kids who are young, to just make sure that nobody ever takes advantage of them, to make sure that their hopes, goals, and dreams are still going to be achieved no matter where it is that you are in life, whether you're here, whether you're not, there's still going to be that life that's ongoing. It's so important to also pick a guardian who's going to be able to take care of your kid the way it is that you would have wanted, right? And if there's one thing I would ask any parent is to just make sure that all these are in order so that in the case of anything, at whatever point, there's this sidekick, yeah, this sidekick called a trust fund to be able to now continue with the journey no matter what. So what can you do right now, right? So first of all, you can create a trust fund account for you to grow the fund for your child. So you can start small. So you can even start small with the 5,000, the 10,000, the 20,000, just to understand exactly how it works. And then and then at that point, it's also important now to choose guardians because as we said, the trustee is already existing. It's an institutional trustee. And then you get life cover to ensure the fund is always full from the very beginning, no matter what. And then if you already have existing life cover, education policies, endowment policies, whether it's group or individual covers, pension plans as well, annuities, you can update the beneficiary list to be able to, so that the funds can go into the trust fund in the case of the unforeseen. And then you fund the trust account regularly. Just think about it as a gift to your children, right? Because me, how it is that I look at it, my kids, I can get them gifts as a toy within a week. They're already tired of it. But right now, what it is that I've challenged myself is before I even get them a gift, I send them money, a bit of money into the trust fund account, and then whatever is remaining, I buy the gift. So see how it is that maybe you can split it. Because when you're 20, do you even at this point, or even your 30s, right now in your 40s, do you even remember the actual physical gifts that you had? You could have felt good about it at that point, but there's the things that you need now. So you have to create a good balance of what do my kids need right now and what it is that can be a great gift for the future. And then you can also allow loved ones to contribute towards the trust fund. So even like when it comes to birthdays, special occasions, you can make this a family thing. Because remember, you're going to have your own unique, account, and this money can be sent directly to your child's, trust fund account, and the money continues growing, and we've made it into a family affair, right? And yeah, that's about it. We're open for questions, but right now I'll also be bringing in Winnie to now even give you a practical example because for her, she has been on the other end as now trustee to explain to you how this whole process works. I don't know if there's any questions so far. Yes. Okay. Okay. So, give me 1 second. Okay, I can see a lot of questions. We're going to take them right now. Give me a second.
It how does it get supported in that pooled fund? How do you build it? Does someone check in on you once you send it? And you can send it through a bank payment and M-Pesa payment. It's received, it's acknowledged, it's invested immediately, so it starts growing in terms of a compounded interest, a daily yield. First things first, you will get a monthly statement issued to you. So the account will be set up in the name that you choose. So you can set up the account in the name of your son, in the name of your daughter, in your own personal name. You can be the beneficiary as well. Once you give the name, it will be set up under that particular name. The person sending the money doesn't have to have any kind of statement or receive any kind of access to that account except for you. So you are the only one who gets statements. So in case you have a birthday gift that you've received from a friend in terms of cash for your child, you can send it directly or you can give them the pay bill and the name of that trust fund account to send the money directly. You will receive investment options if you build your fund to a certain level. You can get investment options, as Mnindo had mentioned, where you can say can I put this money in a different type of investment pool? At least the base investment is a money market fund. As long as your money is growing, it's yielding interest every day, every month, you're assured that it's going to grow. Second thing, no one gets access unless they have verifiable documents. You're a beneficiary. There could be many Winnie Maengis out here, but I have to be the Winnie Maingi of birth certificate number X. So I must show the trustee who I am, and getting access to that trust fund is not just to say your name. You verify yourself, come give practical documents of identification, then the trustee will give you access. As long as you've been named as a beneficiary, as long as you've been named as a guardian, the trustee will give you access. No one else can get access to that trust fund account. That account does not go through succession. So in case something happens to the settler, that particular account simply transfers to the beneficiary. So the beneficiary can keep growing it at their own option. If they want to choose a different investment model, if they want the trustee maybe to unlock, maybe you've been saving for 15 years, you receive also a life insurance payout into that particular trust fund. And the beneficiary says, I'd like to purchase real estate, or I want to buy into a different kind of investment. The trustee will avail the funds for that, as long as the person setting up that trust gave the specific purposes, the purpose of use for that trust. So you can say, I'm growing this fund. It's an education trust fund. The school fees will be paid out. The school fees is paid out to verifiable institutions and against verifiable invoices. So what you do, or what the guardian does, is give the particular documents, and the trustee needs to go through that process of verification. So when you look at the hierarchy of access to information and access to use, because those are two different things, the settler comes first. The settler or the grantor, that's the person who comes first. They're the ones who get information. They're the ones who get power to use. The second person who gets access to information is the guardian. The guardian gets access to use for so long as the beneficiary remains of a certain age or of a certain status that the settler said. So if you name a guardian and say, the trust fund will be accessible to the beneficiary when they're 24, the guardian will get access to the information in that trust fund and access to use for the beneficiary, not for themselves. So they must prove that the use is for the beneficiary. It is highly unlikely that the guardian will be paid direct funds to themselves unless you say the guardian needs to be given some form of upkeep. So in the event of a demise, or that you've been taken ill and the guardian is keeping the child with them, so they're in physical custody of that minor, the guardian can be given upkeep, whether monthly, whether quarterly. It's you who says, I want this particular person to live with my child, and for the inconvenience, or what we call the burden of raising that child, that particular guardian will be given an amount of money that will support food and clothing for the child. Because the trust fund already pays maybe education, it pays Medicare directly to the service providers of those particular services. So you have the hierarchy of who you are. You have the settler, you have the guardian, then you have the beneficiary. When the beneficiary hits a certain age, so they have attained the age of 24, they can come to the trustee directly to say, I want access to use these particular funds. The trustee can grant that access depending on whether the settler said the beneficiary can withdraw all the funds, the beneficiary can continually invest the funds. So the instructions are very clearly laid out to the beneficiary and how they can use the particular fund. And even then, the trustee, remember, being an institutional trustee, they have a pool of financial advisors, they have a pool of legal advisors where they see that the beneficiary is not fully aware or fully keen on how the trust fund has been working, they can have a sit down with them and take them through how the trust fund has supported them, maybe grant them statements of use, see how the guardian was appointed, and give them the option. You want to withdraw? well and good. If you don't want to withdraw, here are the investment options that you can play out. I know you had asked for the legal structure, and the legal structure is simply that you're not setting up a separate trust. It's a pure cash trust. The settler or the grantor can simply withdraw all their money the day they decide they never want a trust fund anymore, or the day you no longer have beneficiaries. You can withdraw all your money and walk away and put it elsewhere, but it gives you a pool of safety. It's a safety and the comfort that you can't get in any other tool other than a cash management trust fund. The regulator of the trust fund is the trust registrar. The trust registrar simply needs the trustee to remain a licensed institution. It They also need the trustee to keep a record of who has set up the trusts under you, what are the statements, and also to be prudent in the investment model that they select. So you're not just keeping the money and then almost giving the burden of reinvesting to the same person who gave you the money. You should be able to offer that service and offer that service prudently. So there are guidelines into how the trustee manages the funds. It's not regulated by anybody else. CMA has its own persons that they regulate, and the Retirement Benefits Authority also has their own people that they regulate. So the trust registrar is the key regulator under the trust fund, unless the law changes and adds another regulator. That is the only person who monitors how the trust fund does. They are seated at the Business Registration Services, so it's still a government regulator at the end of the day. Yes.
Awesome. Thank you so much, Winnie. I think I'm going to ask you the questions that people are asking here.
Okay. Okay.
Okay. For those who are asking if we can share the presentation, yes, we'll share as long as we have your email address. We're going to share as long as you registered, right? And then someone is asking, and the components of a trust fund, is the guardian very necessary?
The guardian, yeah, it's necessary because remember, even when your children are adults, the guardian is the person who is the point of communication between the trustee and the beneficiaries. You could also be a beneficiary of your own trust fund. Maybe it's supposed to be catering to Medicare, and you are not able to directly communicate to the trustee. So the next best person would be the guardian. It would be good to have at least two guardians, meaning you have a primary one and then you have an alternative. If you're setting it up for your own children, you can be the guardian. You can say, okay, for as long as I'm here, I'm the guardian. And in case anything happens to me, you now give her the name of an alternative guardian as you prepare yourself and as also you monitor your social circle and understand who is this person who can pick up and drop off my children from school, who is this person who can go out of their way to simply keep my children fed, who is this person who I can allow my children to spend a night over at their house, because all those persons operate as guardians. That should anything happen to you today, if you don't wake up tomorrow, is this person going to collect your child from the house and go and keep them in their house, or will they just be sayonara and say goodbye to your life? So you need to monitor that. And the added advantage is that information being here, information is power. So not leaving it to chance allows you to just give yourself that hard task of planning ahead of time. Planning ahead of time does not mean it will happen tomorrow, but the day it does happen, you already have a plan in place.
Yeah, I love that. Again, just as Winnie has said, when someone gets incapacitated, maybe they got a stroke. Yeah, if you were to get a stroke, you might need to pick a guardian for yourself. Who will be the person who will come, and say, okay, right now you have a life cover proceed, life insurance, like your critical proceeds have been paid into the trust fund. But who will be the person who's doing the talking for you? I know most people don't like to, they don't think that far, but sometimes someone can be in bed in a coma. Because one of the payouts is when someone has a coma. But in a coma, you can't speak and you have this money. Who'll be the person who is your voice? Yeah. So it will be good even for you to think of, in case of anything, who will be the person who I will trust for myself. So for the people who are asking, can I create a trust fund for myself? The answer is yes. And then Winnie, there's this other question. Um, does the trustee have to invest my money? What if my money is already invested elsewhere, all my assets being liquid? Can the investment have at, say, Mansa X or Standard Investment Bank or Special Fund? Can these assets continue being invested in this platform but be part of the trust? So I think when in there, you can introduce the other way of going about it, because I know with a cash management trust, this might not be possible, but you can tell us.
Okay, that's
People,
a good
people
question.
already have the existing assets. They have
Yeah.
money, own money market funds, they have their own money in their bonds, they have what we've spoken about is you already have this money in the cash management trust, and you use this money in the cash management trust through the trustee to buy other investments. What if you already have other investments on the outside and you want to have access of this structure?
So thank you. Because it's a cash management trust, you must put the cash in. Where you've invested, maybe you've invested in Mansa X, it's a special type of fund. You would need to get advice from that particular investment manager on how they fall in your assets in case you're not there. One, not many funds in the country have a trust layer. They don't hold your funds as trustees. What they anticipate is that a legal representative from your estate, be it your executor if you have a will, or your administrator, they come with a court order that allows them to access the funds and deposit them where they will continue benefiting your children or benefiting the people who have been dependent on you. So where you've already invested, you would need to explore a different option, be it setting up a family trust or simply writing a will that allows you to be the driver of that decision, not to leave it to someone else's option. You be the driver of that decision because you maybe don't want to pull out of those special funds, or they have lock-in options where you're not allowed to withdraw within certain windows. You can still grant yourself that control by placing in a plan, an extra plan being a will or setting up a family trust. A family trust in and of itself can set up a cash management trust of its own and receive any assets that would be received in the event of a demise. So where you pass away and that asset can only be transferred when you've passed away, you have a will in place, and then you have that trust that can collect the cash that you've invested elsewhere. So the answer is a yes and no, but plain and simple, if you're already invested somewhere and you need to keep that investment, then you need to explore a different type of an estate planning.
Okay, awesome.
Mm.
Edwin has been raising his hand. Um, Edwin, you can ask your question. I think I've unmuted. I don't know if I've unmuted him. But anyway,
Yes, you have that.
okay, tell us.
Yes, you can hear me well?
Yes, I can, Edwin. Go.
Awesome. Thank you very much. Thank you very much for the session. Really like the content for today. Highly appreciate. So I had three questions, and I think one of them has been answered about the number of guardians you can have, and the case where you can have yourself as a guardian and a secondary guardian in the event you're not available. Now, as an individual, I do not have any kids yet, but I'm very, very specific around taking care of their future once they come. And I just wanted to understand what would be the conditions for starters, to open a fund today and I as a beneficiary. What would be the conditions for that, or do we follow the same conditions? And secondly, once I've already opened the fund under myself as the beneficiary, and the children come along a couple of years down the line, can I change the beneficiaries, assign myself as the guardian, change the guardian however I wish, as long as I'm here? Those would be my questions. Thank you.
Okay, those are very good questions. Thank you so much, Edwin. So when it comes to now the application process will still be the same. We'll still need you to fill in the form. I think what I can do is I will show you an example of the form so that you can see how it looks like. So what you'll need to do, again, remember, you will be the settler because you're the one who's creating this trust fund for yourself at this point. So you'll put in your details, and then again, you'll put the guardian, whoever it is that you believe can take care of you in the case of the unforeseen. And the answer is yes. When your children come, you can always update. Because remember, you are the settler, you are the one who's creating this trust fund. So it is possible for you to make any changes as long as you are alive. The only time changes cannot be made is whenever you are not there. But yeah, the process is just the same. All you need is your ID and KRA PIN and whoever it is that you choose as guardian, and the account is open and you can continue to contribute. And if time allows us, we'll show you maybe an example of the application form so you can see how it looks like. And for the people who are looking into setting one up maybe this weekend, at least we'll have an idea of how to best go about it. Yeah. So I hope I've answered your question, Edwin.
Yes, yes. Thank you very much.
Thank you. Okay, so I can see other questions. I see Julie has her hand raised. Let's hear Julie.
Thank you so much, Marianne. I always enjoy your sessions. Thank you.
Okay.
And thank you so much, Winnie, too, for this session. I've been in another session for trust funds. I think you had it with Gishuki on Space, yeah, on Twitter. So I think I've grasped good knowledge about trust funds. I think the only questions I have are two. One, in terms of management fees, how does that work? Then, secondly, from what Winnie has said, if I look at myself as an example, I do have a child. I have one child, and I've invested in different instruments. So I do have land somewhere. I have treasury bonds. I have fixed income funds. So from what Winnie is saying, it means basically what would work for such a setup where I can bring in my my current investment portfolio would be a family trust, I think. So how does it work when it comes to assets that are not liquid, such as land? Do you lease out the land? Do you develop it? Do you sell it? What happens to such assets?
Awesome.
Thank you.
That's a good question, Julie. Winnie, I know you can take that one, and then I'll go into the the management fee for the trust fund. I think you can explain to Julie regarding now how it is that she can consolidate all her assets with the family trust.
Yeah, thanks, Julie. It is a good question, and thanks for joining us again from Space to Here. You have assets. So let me explain a family trust. A family trust is a private entity, almost a clone of yourself. It's a shadow of who you are. You create that person so that it receives the assets you have in your lifetime so that it can transcend and transition them throughout your generations. So the first thing is setting up that family trust. Second would be actual transferring. So you transfer the real estate, you can transfer the bonds. There are assets that are transferable. And of course, there are others where you can't transfer, and the option for writing a will have to stand. So you transfer the assets into the trust. At that point, when you're setting up the trust and transferring assets, you are appointing the trustees of your choice. So those trustees are the people receiving instructions on what it is that they can do with the assets that are being received under the trust. Should they sell it if it becomes unproductive? Should they lease it? So it allows them to apply their mind as if they are you. If you were to lease it, if you were to develop it, how would you go about it? The trustee would sit in your position and ask themselves the same question and then try and find options to explore. Yeah. So they can explore these options even with your beneficiaries if you're not there. And with a family trust, the uniqueness of a family trust is you do not have to appoint any other trustee until you're not there. Yeah. You can be a trustee of your own trust and make those decisions as if it's the trust making the decisions. Then when you're not there, someone else can step in and continue making decisions as you. So I don't want to go into too much detail regarding the family trust because here we were discussing the cash management trust, and that particular tool the family trust, what I'm referring to, that particular tool is extremely flexible. You give it power, you give it instructions, you give it limitations, you explore different investment options, then you allow the trustee to now take the sale and go with it.
Awesome. Thank you for that, Winnie. So let me explain how the fee works. So the cash management trust has a fee of 1% that is charged quarterly, 1% of the fund. So say the fund is 100,000 and we've started now. In the next, so what will happen is 1 quarter from now, 1% of 100,000, that will be 1,000 shillings. And they take, 25%, a quarter of that, yeah, because they charge it every quarter. So that means it will be 250 shillings for 100,000. That's the cash management trust, fee is usually the management fee is 1% charged every quarter. I hope that is clear, Julie.
Yes, it is. Thank you, Linda, and thank you, Winnie.
Okay, you're welcome. And then I can see, can the trust fund be designated to get cash saved elsewhere after someone dies? Yeah, I think that is an important conversation to have, Winnie, because most people think that maybe if they write beneficiary, because you see with money markets, there's a place that they write beneficiary. Can the money be transferred to a cash management trust? And maybe at what point can it be transferred, what point cannot? Because, it's not as straightforward as a life insurance or pension proceeds, because those ones, when it's beneficiary, the money is paid directly to beneficiary. But we have money markets which say, okay, there's a place for beneficiary. So will it directly go to the trust fund? And what are the issues that could come up in such a situation?
Okay, so in terms of getting, sorry. Hmm.
So let's say someone.
Yeah, I'm looking for a.
No, it's okay. No,
Just say that.
No, I'm saying I have a money market because I remember I told you, like, after I did my research with fund managers, they said that even if they've put down beneficiary designation, it is not for sure that the money will go to your beneficiary. The only one that you are assured that the money will go to the beneficiary is if it's a non-probate asset, which is a life insurance, a pension, or cash from a trust fund. Those ones are the ones which don't go through the courts. But with the money market, it could happen, it could not. Like, let's say I've put a beneficiary as my kids, and my mom says to me, I want part of that money. It means the whole thing will be stopped and it will still have to go through court. So it's not a smooth transition as, say, through a life cover or, yeah. So maybe you can explain that.
Yeah. I was looking for a way to answer that question without pinning any investment manager. So let me say this. Your funds invested through a fund manager, whoever they be, that person can only act as a pseudo trustee until your funds are transferred into your estate. So let's just call it your estate, because when you're not there, everything becomes your estate. So the investment or the fund manager is not a trustee. They're not allowed to offer trustee services. So they just hold. They just hold until it's able to be transferred. A trustee holds and uses and distributes for as long as they have the funds and for as long as they know the beneficiaries. You naming a beneficiary in a fund running through an investment manager, or a fund manager, you're simply telling them who has access to this information, who has access to getting to the statements, who has access. You can't call that a non-probate asset, because there's no power of nomination under fund management. Nomination is only for what Nyendo has mentioned: life insurance, retirement benefits, and SACCO benefits. You don't have the power of nomination in fund management accounts. They are like bank accounts. When you name a beneficiary, that's just it. They don't get to transfer the funds into the beneficiary's account or withdraw to the beneficiary until that person has gone to court and got permission to get the funds. So they are not trustees, they act like half trustees. Half trustees meaning they'll hold, they won't give anybody else. They'll make sure they give to that beneficiary for so long as the beneficiary meets the requirement of getting a grant of probate or a grant of letters of administration to receive the funds.
So it means then they still have to go through the court process anyway, right?
Mm.
In money market funds forms and they put beneficiary, they think it's automatic that the kids
Mm-hmm.
will. I remember I was having this conversation. People didn't even believe that you cannot get money from your family cannot get money from your bank account. This is why I would advise you, if you have money in your bank account or any money that you want your family to have access to, it's rather at this point, if maybe you don't have money to start a family trust right now, you could just transfer that money in a cash management trust. At least you're assured that it will never have to go through court and it's going to be a smooth transition.
True.
You have money with no access. To know your parents had money, but you cannot even touch it. Yeah. And sometimes depending on maybe the drama around it or even the courts. And nowadays, when you tell us, yeah, the courts don't have enough judges, it might take years to finalize the process. So it means there would have been quite a bit of interruption of your kids' lives. Even if you had land, you can't sell it. You're just stuck in limbo until the courts have decided. That's why at the beginning I asked, do you want the courts to decide or do you want to decide? So that means that if you at this point you only have cash or cash equivalent, a good place to start is cash trust. But as Julie has asked, if you have other assets like land and all of that, you can put it now in a family trust that you create by yourself. Okay. Can the education fund be applicable under trust fund even when the parents are alive and not incapacitated? The answer is yes. Actually, another way of getting organized for parents, if you do not want to always be remembering when to pay school fees, you could be putting money in the trust fund and tell the trustee to be sending money every 3 months when the term is starting. So your job is just to make sure that the trust fund is full and has enough money. All you need to do is share the invoice of the school and the trustee will just send the money. So you don't have to be now going to your account to send money yourself. It can even organize you when you are alive. Remember, the trust funds, you can use it when you are alive and when you are not. So it's there's that level of continuity. So if you're someone who wants to get more organized, you're a busy parent, just be putting money in this trust fund and just say you know when the school starts. So you can be like, on this date, maybe some few days before the school starts, send this money to this bank account for this school. All your job you just need to do is just send the instructions to the trustee. Anyway, okay, when you have investments in 2 different countries like land and property, how can I manage this in one trust fund? You can, as Winnie has said, you cannot manage the investments like land and property in a trust fund. It will have to be a family trust. And if you get trust fund in Kenya, can you decide to use a different currency? Yes, you can use US dollars. Winnie, I think you can explain that, and then the people who are raising their hands, I will give them a chance to talk. Because I know you can have access to other investments and other currencies as long as you can afford it.
Yes, as long as you can afford it. Yes, the money market is in Kenya shillings and in USD. So it depends on your option on how you want to, on what kind of currency you want to deposit into it. So then it will be invested in the respective currency account. Then also it allows you the accountability for knowing I may be saving up money. Maybe I'm saving it up and holding it in M-Pesa, or I'm locking it in an M-Shwari savings. All those things are still inaccessible in case of an unfortunate event that happens to you. So someone would still need to get access in a particular way. So if you're the type of person who is well organized and you're the one who saves up ahead of time for school fees and maybe a sinking fund of sorts, you can simply send it to a cash management trust. Those uses that you have, the future uses, you're just going to be telling the trustee, this and this is what I need, send it here. This and this is what I need, deposit it to me. This and this, you don't even need, as a settler, you really don't need too much explanation for so long as the trustee understands you're the settler and you're using the trust fund for the purpose that you've set it up for. So you can even leave it for open general purpose and lock it in the event of demise. You know, you say that I'm using this trust fund and these are the beneficiaries, but in case I'm not there, it will be used for these beneficiaries only for education or only for Medicare or only for upkeep. So it's you who states that and gives the explanation to the trustee. So you can be saving into it, planning for your future uses with it, allow the trustee to make those payments for you, and give yourself that accountability partner in the trustee.
Awesome. Thank you for that, Winnie. Can you change your guardian at any given moment? Yes, you're the settler. It's by your choice. What happens if, God forbid, the beneficiary passes away before the settler? What happens to the trust fund? It's literally up to you because you're the settler. You can choose to withdraw everything, or you can continue and change the beneficiary. Literally, it's just up to you. Let me give the chances to the ones who've been raising for the longest time. I think Achien, you can start.
Thank you. Most of my questions have been answered, but again, you mentioned that property is not part of the cash management trustee, but what if I have cash investments across different countries and I want to have one trust to manage it? Is this possible? And if my guardians are not in Kenya, KRA PIN, etc., what can I do about that?
Okay. Winnie,
And even how can they then access in case of my demise?
okay, no worries. We've dealt with these cases, but I know Winnie, you can answer that. The first part. When she has
The first part being different country investments. So again, remember, when you're setting up let me call it a succession plan, you're cascading investments. So you have different tools at hand. You maybe have a will, you have an instruction to your financier that in case I'm not here anymore, this is how you need to deal with this. Then you probably have a cash trust that is waiting to receive all these assets. Because even when you take a life insurance policy, you're paying the premiums to the insurance provider, but when something happens to you, the insurance provider will pay the person that you've instructed. So when you nominate the cash trust fund, and you tell the insurance provider, I've set up a cash trust fund here, the beneficiaries are so and so, the trustee will come to collect these funds, or please do send the funds to the trustee for the beneficiaries I've named. That's the plan that you've set in place. So it's almost like having a bucket that collects. As you're funding the bucket is also waiting to collect after you, right? So investments in other different parts of the world can also have a collection point. Okay, so I'm not sure what you're investing in globally. It could be an offshore fund, it could be stock, it could be any kind of global fund. They all operate under different rules and regulations. So as they operate, you can simply create a fallback plan. That's the long and short of it.
Okay. And then, okay, regarding now, if you said if your guardian is not Kenyan.
Well, your guardian doesn't have to be Kenyan. Your guardian doesn't even have to have a KRA PIN unless they're the ones being paid. So the KRA PIN is for tax purposes, right? The trustee meets certain tax obligations. They pay probably withholding tax on the investment that they have. So the PIN is to make sure that there's always that person who you yourself, the settler or the guardian, is not charged tax. You're not the one charged tax, but your KRA PIN is important for verifiability for the trustee. Yeah. So it's not that you're getting a PIN because you are charged a tax. Your guardian can be seated in any place across the world, and simply giving instructions to the trustee is a matter of an email.
Yeah.
Yeah.
Because we've had people who maybe have spouses who are not Kenyan and they don't have a KRA PIN, and it's never been an issue. All they need to do is just send in their passport. And I think maybe an equivalent of their KRA, I mean the PIN that side, but I don't think it was necessary. But as long as there's some sort of identification, which is mostly more important. So Cairo, you can ask your question.
Oh, hi everyone. I hope you can hear me, Minuto.
Yes, I can hear you.
All right, lovely. Yeah, so mine, I just realized way later on that this session was geared towards cash trusts.
Yes.
And I learned way later that they're very different from the family trust. I just wanted to know, I think mine will, are you guys going to organize the sessions for family trusts? That's one. And then just another question now for the married folks like myself. How does it work? How do we, separate that demarcation? Because nothing is promised, right? How do we create that demarcation somewhere down the road that the trust will continue its operations? How do we segregate those sort of contributions? So we have a child, we both want to contribute to the child. That's why the trust is there. But how do we, make sure everybody meets their obligations going forward?
Okay. Yes, we are considering having a session on family trusts because this one we always say that this is a good place to start, but I personally have both for different reasons. Because again, remember the cash trust cannot hold my assets, my properties. Yeah. So it will be important now for me to have both. But anyway, let's go to the question. If you're a married couple, I think even when you're creating a trust fund or a family trust, it's always important to start with the end in mind. So I'll discuss or I'll talk about maybe the cash management trust, and then Winnie can talk about if it was a family trust. But I think if the goal is for the children, it means that you should have sat down with your spouse to decide on the goal of this whole here. I mean, why it is that you're creating this cash management trust in the first place. And then, there's only so much you can do to assure that someone will give their part. But I'm hoping that if the biggest reason why you're doing this is because of the benefit of the child, everybody has to do their thing. You cannot really force someone to do what they do not want to do. But if you're saying that, okay, I'm setting up a cash management trust for the benefit of the child, you can now create a joint cash management trust, and then all of you put in, or you can choose to have two separate cash trusts for the child. Although what I've seen most couples doing is, having one cash management trust and both of them putting together. They're like, you know what, no matter what happens in the future, it's for the benefit of the child. But again, it requires a level of maturity. In the case now, maybe the couple was to say break up, because both of you are settlers. It's because you created the trust fund yourselves. It's up to you to now sit down and decide how you're going. If it is to split it, is how it is you're going to split it, because you are the settlers, the both of you. And okay. Winnie is about to drop off, so let her answer regarding like the family trust. I hope that was clear, Cairo.
Yeah, that's good. That's good. That's
Yeah.
very good. Yeah, we really need a session for family trusts.
And it's extremely critical. I feel like to have like a proper estate plan, cash management trust is good place to start, especially if you're looking for
Yeah,
a stable way of going about things or how to manage actual cash for the kids. But the end goal should be having a family trust. It will save people's.
yeah.
So I
So
think
much headache. Yeah,
we might have to do this again.
I
yeah,
think so. I think so. Then we can lay out how you structure an entire plan to receive and collect all your assets, just to keep yourself your safe, your beneficiaries and your assets in one box. We will take that. We've taken that note, Cairo. Same thing that Mnyendo has answered regarding the trust fund. If you're two people, you can set up a family trust together. If you own properties jointly, especially, it is highly advisable to set up a family trust and move all your jointly owned assets into the family trust. One, it protects you from yourself, your future decisions. Maybe you'll go one day and decide, I no longer want to be part of this investment, but you're already tied. You're joint at the hip if you own properties jointly. Then it also protects your family in case anything happens to either of you, the family assets remain the family assets. Once you float them into the family trust, there's no need to start chasing someone or chasing their family in case something happens to them to give back into your family pool. So the family assets are best protected in a family trust. A cash management trust can also be part of the family trust. You can simply have a way to collect all the liquid assets and have a place that has collected all the hard assets in one. And then you give the opportunity to control, invest, and administer to a person that you trust or an institution that can best handle it in the professional manner.
Yeah.
Thank you. Absolutely lovely.
Yes. I can see a question. I know, Winnie, you're about to go, but let's see. Are you able to use the money in the trust fund for yourself? I think we mentioned that, yes. Assuming you don't pass away. Yeah, a trust fund can be used when you're alive, guys. It can. It's not for, it's not like a life cover that can only be paid out when someone has passed away or gotten a critical illness. Just think about it just like, as I said, any other investment. It's just that the underlying structure is a trust. Yeah. But yeah, you can use it when you're alive. Can you have one trust fund for more than one child? Can you have one trust fund for more than one child, or do you need to set up a trust fund for each child? It's up to you, right? So let me give you like myself and maybe what other clients have done. Because my kids are very young, I just decided to just have one trust fund, and I just contribute one, and it's going to be split 50-50. But maybe your children are a bit more grown and currently are saving towards their own, I mean, like maybe their own specific goals. Maybe they're 11, 12. I think maybe at that time it will be good to split it, because you could be sending money. I mean, because the moment he comes and bring his money to his own trust fund, it will be split with his siblings. So it's up to you. There are people who do two separate ones and call them each by their kids' names, and there's the ones who choose to just put one. I've done one. There's people who've done multiple, but it's up to you and your goals and your vision. Right? Oh, Winnie, before you go, I think this is an important question. What happens to the trust fund if a trustee goes bankrupt? Yeah.
That's a good question. The trustee going bankrupt would mean that the trustee is investing your trust fund as if it's theirs. That does not happen. They shouldn't invest the funds as if it's theirs. So the trustee has to keep the fund and their own assets separate. So that's why, like when you set up a trust fund and you receive your statements, you'll see that the trustee withdraws their trustee fee, the 0.25%, 4 times in the year, and they'll withdraw it from your account and now place it in their own account. So that's also a regulatory requirement, in the same way that retirement benefit schemes don't own the assets. The trustee does not own the assets of your retirement benefit schemes in the same way. The trust fund assets do not belong to the trustee. They're supposed to be held in a separate, distinct platform from the trustee and its assets. And in case someone, because going bankrupt means you are not able to pay your debts, a creditor does not have access to trust fund assets because they do not belong to the trustee.
Yeah, I hope that answered. And then the
May I please ask a question before Winnie goes? I actually have like 4 questions, and I feel like I'll be quick.
okay.
Okay, my first question is, okay, I'm a single person and I'm planning on having children. And I wanted to ask if I could have multiple trusts in different countries. That's the first question. Second question, what are the tax implications on cash management trusts and also family trusts? Third questions, when it comes to getting married, say I go into a marriage with children, what implications are let's say in a prenup, can my significant other have access to these trust funds, considering I've had children outside before I met him? Does he now have access to it, or is it only when I make him like a guardian or a trustee? And then the third is, if you have SACCOs and chama distributions, how do those go into trusts? Thank you.
Thank you for that. Those are really good questions. Haya, Winnie, kazi kwako.
Okay, those are good questions. I think we will have another session where we go deeper into family trusts, but good question. One, trusts trust funds are not taxed. Of course, you're taxed where you invest. So whatever interest income you get, you're charged the withholding tax as everybody else gets charged withholding tax. There's no further tax on it unless I'm not aware of our tax regime, and I am. There's no further tax on that. Family trusts, of course, also do face the similar. They are not trading entities, so they're not allowed to go into business, but they can own companies that go into business. The family trust gets charged tax the same way. Where it invests, it is charged tax on its interest income, but it does not pay corporate income tax. And for you to transfer your assets into a family trust, you will not pay stamp duty, you will not pay capital gains tax. What else? In terms of investing in different countries, different trusts, I don't see why not. Different countries have their own regulations around trusts. The beauty of Kenyan trusts is that they are legal persons. They are legal entities that can own anything globally. It has its own number, identifiable, it's verifiable, and it can own any account globally. It can even join forces with trusts wherever in Mauritius, because a trust in Mauritius would need the Kenyan trust to be a beneficiary. So the Kenyan trust can be the place where you put all your individual beneficiaries, and then it goes collecting trusts. So that's a whole different conversation on trust structuring and also tax mitigation efforts in making sure your trust remains as efficient as possible for you and your beneficiaries. What was the fourth question? We've tackled the tax, we've tackled the engagement in different. So a trust fund, prenup, a trust fund and a family trust is actually the best route out of doing a prenup and also out of revoking your own will. You're a single person. If you write a will today and you get married next week, that will is revoked by marriage because it is deemed that you should have contemplated the marriage and your spouse before writing your will. So it can be revoked if you did not consider them in your will. Two, prenups are really salty conversations to bring up, especially between couples, and especially between couples that are in an African setting, because we tend to believe in marriages for love and trust being the backbone of that marriage. When you introduce the concept of a prenup, people start asking, do you think I'm going to steal from you, or I'm here to leave, or something like that? But because we plan for things that we do not know, the unforeseen can be anything. So when you set up a trust fund or you set up a family trust, anything that you put in that trust or that family, in that trust fund or that family trust, does not belong to your marriage. It is also not belonging to your family. It is not matrimonial property. It is not property for succession. It is not property that should come into the purview of your spouse unless you bring them into the trust. You, on your own volition, you come and say this person is a beneficiary or this person is now a new guardian, because a trust allows you to be flexible with your mind, apply your discretion. You want to remove a beneficiary today, you can. You want to add a guardian tomorrow, you can. So it allows you to have that conversation with yourself first, plan yourself, and then if ever you want to bring in your future spouse, you do at your own option without having to sit down and devise settlements or make prenup arrangements. So you don't really, it's a confidential tool to plan for your own personal assets. And it's also a really good tool to plan for family assets, including inheritance, because inheritance is a whole different conversation.
Okay, that is good. I hope your question was answered.
Thank you very much.
And Lebon, before we go, because I know we've gone over the time, but I think we'll have to plan more of these. Lebon, you can ask.
Yes, hi. Thank you very much for this session. And luckily, I wasn't able to join at the beginning. At first, I was receiving a notification saying that the meeting has reached its limit number of participants. So I had missed, let's say, the first 1 hour. And when I joined, I was being disconnected from time to time. So I wanted to ask if the recording could be shared with us at the end so that I get to catch up and eventually reach out if I have more question or need more clarifications.
Okay, we'll do that. Yeah, we'll just clean it up nicely and then share.
All right. Thank you.
Thank you.
That would be great.
Awesome, Lebon. Are there any other questions for now? Because I think most of the questions I see, someone is asking, other than ICA, which other companies do this? So there's ICA Lion. Interestingly, quite a number of companies do it. There's CPF that also do it. There is Britam who also do it. Which other? There's some banks which also do it. I'll put down a list. But out of these, the people who have the biggest assets under management, and to me, by experience, the ones who've given us currently the best customer experience so far has been ICA Lion. But yeah, quite a number. Even I think CIC also offer trustee services, if I'm not wrong. Winnie, is there something I'm missing? Because those are the ones I can remember for now. Is Winnie here?
I'm here.
Yeah, because I remember you were explaining why ICA Lion was the best compared to the rest, because I have also experienced the rest and I feel like they still have a bit to go, but quite a number of companies offer this. They offer these solutions, it's just that they don't talk about it, interestingly. They've been
Yeah.
a very, very long time.
Yeah, it's true. But ICA Lion
Mm.
has had this trust for more than 20 years, I dare say. So, and it was the first. So it's a pioneer trust. It's a pioneer trust for initially receiving death benefits, in terms of, I have someone in my family who passed away, and their employer or the group that was contributing would like to place these funds under protection for their children. So most of the death benefits would be received, and the children would go through, their life being educated, receiving Medicare. For so long as the trustee is there, the beneficiary will be catered for. So even if the guardian passes away, the trustee will fish for another guardian from that particular family, or the next of kin to that beneficiary, or until the beneficiary is able to manage themselves. So the trustee involves themselves in the beneficiary and monitors their fund and how it grows. So even where upkeep has been requested by a guardian, where maybe the settler had not indicated how much upkeep, the trustee will involve themselves. And because of experience, ICA Lion seems to be able to make certain decisions and guide settlers in decision making where maybe there are gaps or there's lack of information. They will guide you step by step.
Okay, thank you. Thank you for that. Someone has asked, in the event trust creator passes on, the guardian 1 and 2 also passes on, an accident happens where all people in the same family perish and the beneficiaries are still minors, how will trustee designate other person that has access to the money? So usually there's a place you can put the primary guardians and secondary guardians, unless like 6 people died at the same time. I don't know what the chances are, but usually there's a part for the primary guardians and then the secondary guardians. Winnie, what happens if all guardians are dead? Plus the grantor, the settler.
So where guardians pass away, where is the child staying? Because an assessment has to be made over that child. Yeah. The guardian is probably the one keeping the child alive and sheltering them. So the child has to be assessed. Where are they staying? Do they have any more family? Can the trustee find them a home? Because the trustee must take care of the beneficiary.
Yeah. So the only question will be, will this person, because you see, like, let's say, for example, the parents had already told the guardians who were in that list that they are guardians. That means that maybe the person who's living with the child does not know of the existence of the trust fund. What happens in such situations? Will ICA, because you as ICA or as a institutional trustee, will not know that someone is dead? Or how will you?
Oh, no, we do check-in. We do random check-ins. And so the trustee's main role is to the beneficiary. So imagine a situation where the guardian has passed away and the guardian themselves were not directly related to the beneficiary. So what does a trustee do? And mostly because we live in a society where someone has passed away, you'll find people around them who can give you information. So assessments and interviews are done, one, to the beneficiary. How do you access the beneficiary without a guardian? You must find someone. So you'll either go through the school that you've been maybe interacting with, or you'll go through the next of kin to that guardian to understand where the beneficiary is seated. Yeah, where the guardian has been receiving some form of upkeep, you will realize that the beneficiary may not know that there's a trust fund, but someone in the guardian's life knows that there's a trust fund that they were receiving assistance from. So you'll see the trustee has to find someone in the beneficiary's life who can take care of that beneficiary. Either that or, the trust fund will fail. And the trust fund cannot fail for so long as it has a beneficiary and has assets that are being managed.
Okay, that's good to know. Lynette, I see you have a question. I think that's the last question you're going to take because we've gone really, really over time. It's good if we've seen you're interested, but you can also, check out you can email us, or even I've shared a number where you can you can send a WhatsApp, or even fill in the trust form in the case now you want to set up one. But we'll also share a video on how someone can actually apply. We thought we'll have enough time to show you how the grant letter looks like, but I think I may just have to do a separate video and share it with you on email. Yes, Lynette?
Hi. So I had this question where besides doing the usual monthly contributions and you want to invest, say, in bonds and stuff, so are you supposed to ask like ICA or whoever will be taking care of the fund to do it on your behalf, or you can just open your own joint one, then you just tell them to send the money to them, or how does it happen? Then, so in the case of now getting the dividends or whatever it is that you want to invest in, it just comes directly to the fund. And then, so when you're trying to like maybe send some funds from the fund, how do you approach it? Since I'm assuming, will there be an account, or how does it operate?
So remember, you've already opened the trust fund account. Maybe you've already started the contributions, and then you are at maybe 300, 500,000 and you want to buy bonds. So what you need to do is just give instructions to the institutional trustee. It's not you who's doing it. They're already there. They're there to serve you. So you just tell them that you want to buy specific bonds. And remember, the owner will no longer be you as Lynette. Remember, right? So you will give them instructions, and then you'll even further give instructions that the amount of money that is paid out, maybe in form of interest, can be reinvested. So all you just need to do is just to give instructions to the trustee.
Okay, thank you so much.
You're welcome. Guys, it was such a pleasure. Thank you. I saw that most of you literally stayed from the beginning to the very end. I can see this is a very interesting topic. So we're going to organize with Winnie to have another conversation on, proper family trust, because again, this is, as I said, this is a good place to start. But if you want to create something that is more custom made, because here you just have to use the structure that is already existing, it's a good place to start. It's a good place to now put money away for your kids. It's a good place to administer, say, your life insurance proceeds, just for your own peace of mind, and to just make sure your children have something. But now for people who are maybe proper investors and looking into now building their portfolio, and you need a proper structure to build your investment portfolio on, because again, it does not make sense to create so much wealth with no structure. We have structure in our organizations, but for some reason we don't have structures within our families. So we need to be able now to create, say, that family trust, so that our family members will never have to spend time having to go to the chief, to go to the sub chief, to be able now to just get that letter and start the succession process. And again, also the advantage of having a family trust is the fact that all your matters will remain private. Because for people who have ever gone through now the succession process, you know that when someone passes away, the whole thing has to be gazetted. It is all over, and the courts are open courts. But what happens if you want to create your wealth within a certain structure? You want to make sure that there's protection and there's also, in addition, privacy. And now you create your proper whatever, like your proper rules and regulation. And as Winnie has said, you create a proper clone of you. So this thing is literally just a continuity of you. So we're going to have that conversation. We'll discuss and see when it is that we can do it. But we'll send an email and you let us know if it's something that you're interested, so that now we can prioritize you, because you've seen that the spots are usually limited. And so that now the additional value of being here instead of our, accessing the recording is you can ask your questions. Yeah. And yeah, thank you so much for your time. I will really urge you to now put your children's finances in order, your own finances in order, create that structure. Don't wait until you have money for a family trust to get started in creating of structure. You can start right now with the cash management trust, just to understand exactly how it works. And then even within that, for the people who are currently our clients, we're going to be giving them even possible discounts when it comes to the time when we're creating like a proper estate plan. And also another thing is that we're looking into now starting some sort of challenge for our kids to just put our matters in order. But you will be the first people who are notified when that gets started. But yeah, you can always go to our socials to be able to get access. I've also shared the links in the case you need to get access to now the trust fund forms. You want to fill that up. And yeah, for now, that's about it. And see you next time. Have a good afternoon. Have a good time. Bye.
Thank you so much.
You're welcome.
Thank you, Nindo.
Thank you.
Welcome. You're welcome. I
Thank
hope you learned
you. See ya.
something, and I hope you'll implement, please, guys. Not to hear and not to do.